Hello and welcome to this very special edition of The Money Show. I am Kavita Thapliyal and you are watching National Nutrition Week special on The Money Show, where it's a grand finale of the entire week that we have put up for you. And today the show is very interesting because we're going to have viewer queries based on the age group. What's the right kind of financial portfolio, or in financial sense or in the diet sense, the right kind of nutrition for their portfolio will be advised. And we'll be also taking an overlook of the market and guiding you in terms of rebalancing your portfolio, revamping, reshaping, anything that you need to keep in mind looking at the changing trends in the market. I have very special guests with me, and let me introduce my guest. I have Ashish Shanker, man from Motilal, Oswal, MD and CEO, Motilal Oswal Private Wealth Management. Welcome to the show. Kaustuv Belapurkar, Director Fund Research, Morningstar Investment Research India. Welcome to the show, and I think for the first time we are meeting physically. I mean, having some interaction in the studio calls for a special show, definitely. So let me begin, since we're talking about National Nutrition Week over here, and yes, we will be talking about our financial portfolio and the right nutrition for that. But apart from that, what are the things that you take care of in your nutrition? Balanced diet, talking about typical thali,
right.
Nutrition thali for you,
right.
Which is your favorite food group in the thali, and what's the right kind of nutrition for you right now that you have planned for yourself?
So Kavita, I think this show is very apt. As you mentioned, a balanced diet is extremely important, and anything in excess is bad for the body, right? So typically for me, the Indian thali works the best, right? You have some carbs, which is your rotis or rice, one of the two, right? And then you have your legumes, which is dal, and lots of sabji, different kinds of sabzis. I think this in itself is a very balanced and nutritional diet. Other than that, I mean, you have some salad, greens, etc. on the side. And yes, on occasional days, I love to have some dessert,
right.
Because that then completes the meal.
Right.
I think
everything in moderation.
Yeah, absolutely.
That works for you.
Absolutely.
What about you? Do you follow any kind of fad diets, keto, intermittent, or anything of that sort?
So, not a big fan of any of these diets, to be honest. And I think what Ashish really hit the nail on the head.
Yeah.
But just a little bit of a different twist from my own personal perspective.
Sure.
For instance, there are people who are intolerant to certain kinds of. So, for instance, I'm lactose intolerant.
Okay.
So, I have to tweak my diet. So while I still follow the same basic rules, but for instance, when I need to consume protein, I have to be very careful about plant-based proteins or animal protein, as whatever the case may be. That's a little bit of tweaks that I would make to my nutritional portfolio, so to speak. But otherwise, the basic tenets, obviously, want a good balanced meal. And don't overdo anything. I think that's really the key thing to keep in mind.
That's the key thing. But then, see, we're talking about the markets. We're talking about your financial portfolio, which obviously is aligned as per your financial goals. No doubt about that. It's going to be very case specific and a very customized thing to make your own financial portfolio. But just a general view from both of you, actually, I want this. Looking at the current market situation, what is that one dose of nutrition that should be there in your portfolio? When I'm talking about nutrition for your portfolio in terms of financial terms, it could mean what kind of asset class or your exposure in that particular asset class should be going up or maybe reducing, considering the current market condition.
Yeah. So, Kavita, whilst we are all bullish on the long-term prospects of our economy, stock market, etc., but often what happens in a bull market is risk tends to get ignored.
Right.
Okay. So from that point of view, I think it's very important to have some gold in the portfolio, right?
Okay.
We always recommend about 10-15% allocation to gold. By the way, gold, in spite of it being a conservative asset class, has done quite well in the last 5 years.
Definitely.
And someone was just telling me that, our moms or, women in India have probably done as well or better than equity investors in the last 5 years, because gold has given very good returns. So my advice would be, don't forget risk. And a good way to mitigate risk from equity markets is to have some gold in the portfolio. This is not a time, if things are going so well, you sell gold, you sell debt, and there is that instinct to sell everything and pile on to markets because it's doing very well. So I think that is something you have to be wary about. So I would say, if there is one thing you need to have in your portfolio today, is gold. It completes the thali of the portfolio.
The thali of the portfolio. What about you?
Yeah, I would agree with Ashish in that sense. The other take that I probably want to add is, and what Ashish alluded to was that there's a lot of exuberance in these bull markets, right? So investors gravitate towards a particular asset class. So what tends to happen is that everyone's super loaded up on, say, equities. And you forget your bread and butter fixed income. I think that's another one that's been ignored for the last few years just because of the superlative performance of the equity markets. Now's a good time to just step back and think that, is my portfolio over allocated? Maybe I should book some of those profits and get into a more sort of steadier, safer asset class like fixed income to a certain part of my portfolio, depending on what my asset allocation needs demand. I think that's a good thing for every investor to think about doing right now.
But even within equity, you might want to rebalance?
So, I normally recommend a 1-year frequency for rebalancing. That just works very well. We've done a lot of back tests on asset allocated portfolios. 1-year rebalance works extremely well. What I would do within equities is if any pocket of the equity portfolio has done extremely well, right? This is very contrary to human nature. Okay, let's say a particular fund, to give you an example, a micro or a small cap fund has done phenomenally well over the last 5 years.
Great.
It may be a good idea to rebalance it back into a flexi cap or a large cap fund, right? But it's very contrary to human emotion.
Difficult to do that,
or nature, because you want to put more money in something that has done well.
Exactly.
But this is one thing I would recommend, to relook at the equity portfolio, relook at allocations like he said. If let's say you are your strategic allocation is 50, it's gone to 60 because the last 3 years have been great. Maybe you want to bring it back to 50. Now within that as well, if small and mid cap portfolios have done phenomenally well and the risk is gone up beyond what you would like it to be in your portfolio, then it's a good time to do that.
Sure. Same thing for you?
Yeah, I think, Ashish touched upon the market cap. The other thing is also style, right? With something which people tend to not always focus on. We always look at the end result of the returns of a portfolio. And if I just take you back in time in 2020, everything was growth, everything was working in favor of growth, all the money was piling into growth. Anyone who was sitting in growth was ignoring value then. Values made some very good returns in the past few years. If you've made good money in value, maybe some money should be taken off the table, reallocated to growth as so I think that's another perspective to think about from an investor's portfolio.
I think a lot of other aspects now, I can just go on with the discussion, but then we have to start with our viewer queries. And the way we've decided our viewer queries today is we are taking age group, say 20 years, 30 years, 40 years, 50 and so on. And we are going to help them design their portfolio based on their time horizon, their risk appetite and financial goals. So Kaustubh, I'm going to start with you. I think the question for you that I have is, I'm just going to read it out. Okay, so his name is Tamil. And he's 38 years old, and he says that he needs to create wealth of almost 3 to 4 crores in 12 years. And he says that he is ready to invest almost 50,000 per month, and he will increase the investment by 10%, so stepping up his investment. And he's also aware that the market is at all-time high. So what kind of mutual funds would you want to recommend?
Sure. So I'm glad that he's asking this question, and he's got a reasonable sense of what he's looking for. A couple of things when I do the math behind what his requirements are and what he's looking to invest. The first thing he will have to do is he'll have to substantially increase his SIP amount. He's starting at about 50,000 today.
Right.
And we have to put everything into perspective in terms of conservative return estimates. Also thinking about the fact that when he comes closer to his goal, he can't be allocated all to a volatile asset class like equity. He will have to gradually reduce equity exposure and move into fixed income so that he protects
closer to the goal.
To the goal, right? So all of that put into place, you have to think about conservative return estimates and not what the markets have done in the last 3 years, right? So the one thing he'll have to do is aggressively step up his SIP like almost 20% every year. That's the bare minimum that he will need to do. The other thing would be that we'll want to keep some sort of liquid cash available to him for his emergency needs. But the remaining portion, and that could be 5-10% depending on what his allocation looks like. But the remaining can actually go into just a good mix of equity funds, right? And it could be across large, mid, and small. And I would think where we're sitting at with a 12-year horizon, we can probably do like a 50% large cap and about 30 between mid and small, more to mid, and maybe another or 10% to international equities. I think that's one thing that we tend to ignore. That would build a good balanced portfolio to start with. But as we approach, like I said, when we get into year 5 and year 6, he's 5-6 years away from his goal, he'll have to start stepping down his equity exposure.
Okay.
Because you want to avoid the event risk of, if he needs 3 or 4 crores at the end of his time period, he'll need to make sure that he stepped up his SIPs and also start reducing his equity exposure as he enters year 6 and onwards for his portfolio.
Okay. So we surely don't know whether it's a market high or market is going to go down. We can't predict all of that. But then one question that he might have in his mind is this the right time to start investing?
Right. So I don't think he's from Bombay, but I'm sure I can relate, and I use this example to make it very relatable. That if I'm standing at a local train station, let's say the other station, right? Okay. And I'm waiting to catch a train, and it's so crowded, I say, okay, let me wait. I'll come to the next one.
Sure.
I'll keep waiting, and I'll always miss the train, right? So the whole point about SIP investing, it avoids that timing risk. Okay. Because no one can predict in the short term, is the market going to go down, is it going to go up? When the COVID crash happened, everyone was thinking that, okay, maybe it's going to stay depressed for a while, but we saw the sharp rebound that happened. We've seen instances like this many, many times in the past, and it'll happen again. So the best way to play it is an SIP, right? I mean, if you get a monthly paycheck, that also instills that financial discipline that I'm going to park an X percentage of my paycheck into SIPs. Okay. Automatically you know that you're saving that money every month from your paycheck, and it avoids the timing risk of markets. That's the best way of doing it, not worrying about, is it too high, is it too low? But obviously you need to figure out your allocation depending on what your time horizon is and things like that.
Yeah, and keep reviewing your portfolio every 6 months. Yeah. Next question is for you, Ashish, and it's from Jagdish, and he's 26 years old. Okay, and he's currently investing in 3 funds. He's got JM Flexi Cap, Motilal Oswal Large and Mid Cap, and Kotak Nifty Next 50. 4,000 each in the first 2 funds, and then 2,000 in the last fund. And so small and mid cap valuations are very high. And he also says that I want to add 1 fund, maybe a factor fund, and will that be a right fit for his portfolio now?
Right. So again, I'm just taking cue from what Kaustubh said. Sure. He's an SIP investor. Yeah. So for him, and he's got a long runway. Yeah. Right. He's 26. And first of all, I commend him for thinking, so strategically. So he's got a long runway ahead of him. So my view is that he shouldn't be worrying about valuations because, in fact, contrary to what he thinks, and again, even I'm answering Kaustubh's query. He should actually pray that the markets crash and remain low, because he'll accumulate more units in the initial phase of his initial saving phase, right? And that will give him more units and create more wealth for him. So actually, he shouldn't be worried about valuations, to be very honest. He's got a long runway. Right. In terms of adding another fund, I mean, given what he already has, see, I'm a big fan of flexi cap funds. Okay, because why so? Reason being, the fund manager has the flexibility to decide whether he wants to do large cap, mid cap or small cap, and he can decide bottoms up which companies he is positive on, he or she is positive on. And if you take a longer runway, let's say he's 26 and assuming he wants to retire by 50, 55 or 60, you've got 25 odd years ahead of you. I think the returns even out from small, mid and large, the returns even out over a longer period. So flexi cap is a far better fund to add, because these factor funds have their phases, they are basically trend following. So today a value factor may be doing well, tomorrow momentum may do well, then you may have a low vol doing well, but it keeps changing. But a flexi cap active manager will have the flexibility to maneuver the portfolio depending on the market situation. Okay.
All right. So you would recommend him to not to have a factor fund?
Yeah, I would say add a flexi cap fund.
Flexi cap?
Yes.
Okay. So the one that is there is what, large cap oriented flexi cap?
No, a flexi cap can go anywhere, but typically these funds have about 50 to 70% in large cap and 30 to 15 mid and small. Yeah.
Let's move on quickly. And Ashish, for you, I have Mr. George's query from Kochi. Very interesting one. He says that he's a 70-year-old government pensioner who wants to invest 50 lakhs, which he's obtained from salary of from sale of a property for the higher education of his grandson, which starts after 6 years and may extend the next 10 years. Annual amount needed may be 10 lakhs per year. He has selected few mutual funds for lump sum investment. He selected ICICI multi-asset 10 lakhs over there, HDFC BAF 10 lakhs, Mahindra Manulife multi-cap 10 lakhs, JM value fund 10 lakhs, DSP Nifty 50 equal weight index 10 lakhs. The selection, your take on that, and also the entire strategy that he's.
Yeah, so look, I think barring the multi-asset fund, all the other funds are equity based, right? So if I look at the next 6 years, right? He says he's got 6 years to plan for the education.
Yeah.
Even if you take a 10 to 12% return on the portfolio should double.
Okay.
Okay. So 50 lakhs should become anywhere between 80 lakhs to a crore. Okay. After that, he's talking about 10 lakhs every year, right? So even if he does an SWP is basically a systematic withdrawal plan or a redemption. He can redeem, proportionately from each of these funds every year. He will still last it out because let's say that crore again grows at 10 or 12%, right? So which means on that crore you're anyway generating 10 lakhs every year.
Yeah.
So even after withdrawing 10 lakhs every year, you'll still be left with a fair bit of corpus after funding the education.
Okay.
So he's fine, if you ask me.
Yeah?
He's good to go.
Okay. Perfect.
I mean, I would probably tweak some funds here and there, but I think allocation is most important.
Yeah. So
allocation, he's an equity and one multi-asset fund.
Yeah.
I think maybe closer to the goal. If he's very close to the goal, let's assume that he's very. Let's take 1 crore as a target for this portfolio in 6 years, right? Whether the 1 crore happens in 4 years, 3 years, or 5 years, or 6 years, it doesn't concern us. So the moment he hits that 1 crore number or a 90 lakh number, he should move more money to multi-asset.
Okay.
Right?
Okay.
So he protects the goal.
Okay.
My name is Gaurangi and I want to invest in crypto. Should I do that? If yes, how? And if not, why? If not crypto, then should I invest in the share market? I'm 30 years old and my salary is 65,000 per month and I can save around 25,000 per month.
I'll give a disclaimer. I'm no expert on crypto. I do not understand it at all. And the biggest challenge for a lot of us is that if you don't understand it, you can't value it, you don't know what's going to move the needle on that, right? So I think to a second part of the question, so the crypto bit, I would say don't do it.
Yeah.
If you don't understand it, don't do it. I mean, even if it's a fad or it's done exceedingly well in the recent past, best to perhaps stay away, or maybe just, if you really want to dabble, just a very small proportion, of sort of your side portfolio. But I think to the key part of the question in terms of how do I invest that 25K, do I buy, direct stocks or funds, right? I mean, my clear answer is buying funds, because a lot of DIY investors, who came in during the COVID time, obviously got excited. I mean, in a bull run, everyone is super excited about the returns the portfolio's made. Yeah. But the biggest challenge is that, when you look at the polarization of returns that can happen even in the index stocks, and that is the challenge. If you don't identify those top 10% of the stocks that have moved the needle, you're gonna actually end up probably underperforming cash also. So the best is to, you have great active managers in the country. If you can't pick an active fund, then just buy an index. That's also all right. You're participating in the market, but doing that in a systematic, scientific way. So I think build a portfolio of equity funds, and majority would go into large flexi, with maybe about 40% into mid and small.
All right. Last question, and this is from Mr. Subramanian Pichai, Ashish, and he says that he's 60 years old, retired with a pension of 20,000 per month and no other income source, has a health cover of 20 lakhs, and mutual fund corpus so far is 1.2 CR in 4 flexi cap funds. Monthly expenses are around 50,000 per month. How can he redeploy this 1.2 CR and get regular income of 50,000 for next 25 years?
So, look, the traditional answer will be to move more money to debt.
Right.
Totally. As you retire. Right. People advocate anywhere between
a large chunk of the
50 to 60% in debt. But I'm not going to give you a traditional answer.
Okay. Interesting.
Okay. See, his corpus, equity corpus, is 1.2 crores.
Right.
right? He's going to get 20,000 in pension.
Right.
So his gap is only 30,000.
30,000.
Now, even if he sets up a systematic withdrawal plan from his 4 funds, let's say 30,000, so you set up 7,500 per fund.
Okay.
Right?
Sure.
The total corpus that you need to withdraw every year is 3,60,000.
Okay.
Right, which is 3% of his total capital. Right? And even if you conservatively take equity compounding at 10 to 12%, I'm not even talking about 15-16% that it's compounded in the past.
Sure.
He'll have a fair bit of corpus to leave for his next generation.
Interesting. Okay.
So if you ask me honestly, but of course, he has to brace himself for more volatility.
Okay.
So that 10 to 12% return is not going to come in a straight line.
Right.
You will have 2-3 years of great returns and maybe 2 years of not so good returns and maybe 1 year where the portfolio will go down 20-30%.
Right.
He has to be mentally attuned to that, which I think he would be, because this corpus that he has built in equity funds would have been done over a period of time or through SIP investing, right? So he would have experienced equity markets, I'm assuming.
Right.
So if he is okay with that, I would say he's done brilliantly. He just needs to fill the gap of 30,000, which is like 3.6% yield on the entire 3% yield on the entire portfolio. Even after withdrawing that, he'll have a fair bit of money left in the portfolio. Right? Okay, let me go one step further, so it'll make it very clear for him. Let's say you withdraw 3% per annum, right? And the portfolio compounds at 12% per annum. So which means the portfolio net is actually compounding at 9% per annum. So his portfolio is still double in 8 years. So after 8 years, his portfolio will become 2.4 crores. Right? This is important, reason being that what he's assuming as a monthly expense today will keep going up also over a period of time. Right? So if you're assuming that your expenses are compounding at 6% per annum, which means your expenses are going to double after 12 years. So after 12 years, he's not going to need 50,000, he's going to need 1 lakh a month, right? And if this equity portfolio does what we just spoke about, then actually he can, spend more lavishly and have a much better lifestyle during his retirement.
What about diversifying? Because he's got 4 flexi cap funds.
I think it's well diversified.
Well diversified.
4 flexi cap funds, on an average, each of them will have 70-80 stocks.
So should he be checking the portfolio of the funds? There should be no repetition in terms of exposure in companies and sectors.
Not really. I mean, as long as he's comfortable with the 4 managers, and I'm assuming, like Kaustubh mentioned, he's done the style diversification. I mean, every fund manager has his or her own approach.
Right.
So if he's working with a wealth manager, he'll be, advised appropriately as to whether these are the 4 funds he should hold on. But look, he's done well. It's flexi cap funds, and allocation matters 95%, right? 5% everything else. So I think he shouldn't bother much.
All right, so I do have a lot of other questions, but then it's time up on the show. Thank you so much for being on the show.
Thanks.
But then before I wind up, one last question, because you're talking about nutrition and you're talking about financial portfolio, nutrition for a financial portfolio. What is that one aspect of your food nutrition and your financial portfolio nutrition that you would just completely stay out of, like a strict no matter what?
For me, I think sweets or something.
Sweets? Really?
As much as possible.
Yeah,
I do. I love sweets, okay, Salami, but then I tend to gravitate to the other extreme. So as much as possible, stay away.
Okay.
I think from a financial, maybe just the esoteric sort of asset classes like, crypto and all, which I completely stay away from.
Ashish, what about you?
So let me extend this analogy between food and investing, right? So first thing I would stay away from is binging. Right? Binging on anything. I mean, you can have everything in a balanced manner, and stay away from snacking. I stay away from snacking, okay? And this is akin to, when you're investing, like the guy asked, should I invest in crypto? Should I put money in a power stock? Should I put money in a thematic? That is akin to snacking, right? And snacking is not good for health. You have your balanced meal on time, regularly, and you have a cheat meal. It's okay. I mean, 10% of your portfolio, you want to follow a trend or some passion that you've got, do it on the side, right? But A, avoid binging, and B, stop snacking, right?
Interesting.
I think that will serve you well in the long run.
That's great advice. Absolutely.
All right, so on that note, thank you so much once again for being on the show and helping our viewers with everything related to wealth, nutrition, as well as your health nutrition. Thank you so much.
Thanks,
and it's a wrap on the
Pleasure.
show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.